Hey everyone, we're going to take a look at the Federal Reserve Asset and Liabilities of Commercial Banks report for American banks. Is number H8, is released every Friday, and the month of August and July have been particularly spicy. There's actually been some recent revisions as of March 26th that states, I think it's kind of funny, that there's been system enhancements releasing incorporating minor revisions to historical data due to rounding differences. However, these four line items, bank credit, loans, and leases in bank credit, real estate loans, and consumer loans, was corrected, each in an increase of 0 to 3% and changes in corresponding growth rates. Now, I think it's pretty interesting that they can be so bad at math that some few rounding errors can change something such as bank credit percentages by 3%. That's fairly absurd. I think that's just a joke. It just goes to show what kind of oversight they actually have on these guys. But taking a look here at the historical data, we've got August 13th, and there's 11 tables on this. You can see this is August 13th, straight from the Federal Reserve. We're going to go to table 2 out of these 11. I'll just scroll through so you can see how much money is on the line here, because they get larger and smaller as the table varies. As you can see here, August 4th, the bank credit is increasing. And that's because a lot of the money that is being printed by the Fed is slipping out into the economy because it's so much that banks can't handle it. So we've got record numbers of securities. Now, mind you, this is expressed in billions. So this is 5,304 billions, which I think is around $5 trillion. Yeah, it is, because this table here, the total liabilities, has increased as of August 4th to 19,822 billion dollars. The majority of these are coming from deposits. However, the issue here is that deposits with banking are a liability because they don't just sit in a vault. They get put into the stock market, mutual funds, bonds, and the RRP now, the reverse repurchase program, which is getting to all-time highs. So as you can see, these numbers are just getting exponentially larger with their deposits because of the amount of money that's being injected by the government to artificially boost the GDP of America. So the only reason that we've got a half decent economy at this moment, or we had, I should say, is because of the absurd amount of money that's been printed. Okay. We're going to move on here and we'll talk about that a little bit later. We're going to stick to this table and the federal assets and liabilities reports because they're actually fairly important. As you can see, these numbers are just skyrocketing and they show no signs of slowing down here. This here is other liabilities, including trading liabilities alone. Okay. Now this is $855 billion just on this table too, so there's a reason that the top 4 banks in America owe $168 trillion in unrealized losses in derivatives alone, which don't include naked shorts, synthetic shares, FTDs, and shorts that are marked as long positions. Okay. A short can be marked as long very easily by hedge funds and market makers. And what that does is it is literally the definition of cooking the books in the Urban Dictionary, because they're taking something that is actually a liability and making their accounting books look like it's asset, which is cash on hand. It's fraud. So not even taking that into consideration, this 168 trillion is owed by the top 4 banks. Okay, that's JP Morgan, Citibank, Bank of America, and not Wells Fargo. They're number 5, I believe, but Goldman Sachs. Okay. And these 4 large banks hold 89% of the total banking industry notional amount of derivatives out of 1,385. So there's 1,385 banks in this industry. And these 4 alone hold almost 90% of all that debt. And it's all unrealized. Okay. Out of that, 61.8% of it is being traded on dark pools. There's a lot at hand here. Okay. With this H8 reports, we'll go straight back to it up here. You can see the amount that these are consistently increasing, especially when you pull up certain things like the Office of the Comptroller of the Currency quarterly report on banking, trading, and derivatives activities. Okay. This is the most recent one released, June 2021, for the first quarter of 2021. It's always behind a couple. All right. And you've got a lot here. Here, holding companies. What is a holding company? Well, that's a pretty easy answer. For some reason, it's not pulling up there. Regardless. Credit swaps are up 1,603% for holding companies. And a holding company is a company created to buy and possess the shares of other companies, according to Oxford Dictionary. What does that mean? Shell corporations. Okay. And their credit swaps are up 1,600%. And you take these US commercial banks, which you already know what a bank is. Credit default swaps are up 3,400% in 1 year. Okay. This is out of hand. This is the exact same thing that they did in 2008. They've continued to do it. They've moved around the tranches of garbage and given them fancy names. Take a look at this. This speaks for itself. The interest rate is down 100%. Credit default swaps are up 3,400%. But because of the amount of money injected into the system by the Fed, their total trading revenue is up 56% year over year. So more than half the money that these banks put in the bank, or in the market, I should say, came last year from 2020 to 2021. That is the big takeaway here. 56% year over year change from 2020 to first quarter of 2021. So the Fed has pumped so much money into the economy that the banks have no idea what they're going to do with it at this point. And it's getting stuck in shitty bonds and treasury bonds and overnight, because they have to maintain this on hand to maintain their margin positions, because they're so underwater with these derivatives that at any moment when the stock market takes a nice hit and it's too much for 1 or 2 of these funds to handle, it's going to cause a cascading domino effect that will have some severe consequences. Take a look at these gross positive fair values and negative fair values, again, expressed in billions of dollars. Okay. These are down 22, 27, 10, 46, 37%. So their gross positive fair values are all down by 25%, by a whole quarter. What they have is almost completely worthless at this point. Even the gross negative fair value has decreased. So what's happening? They're just shuffling money around. 189 trillion is what they've got. This is all directly tied to these derivatives that can be seen in subsection footnote 22, line 39 of the Federal Reserve H8 reports, which include subordinated notes and debentures, net deferred tax liabilities, interest, other expenses accrued and unpaid. That's pretty damn vague. Accounts payable, liabilities for short positions, not naked shorts, just short positions. And those are estimates, by the way. Derivative contracts with a negative fair value. Contracts that are losing money. As determined by this interpretation, which again is also very vague and could actually be, very, very likely is much more than actually stated. Additionally, it includes quote unquote other trading liabilities to which fair value accounting has been applied. So there's just other trading liabilities that they don't really know how much they're going to lose. They just applied fair value accounting. And then lastly, other liabilities. Come on. Failures to deliver, FTDs. That's what this is. But they don't even know how many FTDs they've actually got. They have no fucking idea at this point, because the majority of them aren't even being reported properly. They're cooking the books and marking these shorts as longs. So these FTDs are just getting kicked around, and it's been happening since 2008. It reared its ugly head in 2011, 2013. We're at a point here where these things have gotten so out of hand, it can't continue anymore. It can't continue. It's going to cause an extreme correction in the market, and a lot of wealth is going to be transferred. And for the first time in history, the 99% might see a good amount of that wealth. Now, let's back it up here. Go into these reports. It's very valuable information. This is the OCC, the Comptroller of the Currency report. Take a look at what we're looking at here. Look at 2008. That was a mess. And in the first quarter of 2021, banks generated 38% of consolidated holding company trading revenue, an increase from 34%. What does this mean? They're making more holding companies to move the money around all around the world. It's fraud. It's downright fraud. It's nefarious, and it's wrong. Now, what are they doing? They're using something called netting. Okay. Netting is a very, very, very weird way for them to move money and change these contracts from one bank to another counterparty. For example, contracts with a positive value to bank A, 6 of them at $500 have a fair value. And you've got contracts with a negative value to bank A, and they can move 4 contracts for negative $350 with a gross negative fair value. Total contracts 10 with a value increase of $150 instead of when you add all this together. What does that mean? It means that they're moving this money around repeatedly just to be able to show numbers like this as gains and hide numbers like this as losses. That's in layman's terms. Okay. If you want to, go ahead and read that, put it on pause, and then you can look it up if you don't believe me. Now, net current credit exposure in billions of dollars. Well, their credit exposure has decreased by 15%. That's not bad. However, the decline in 2008 is largely resulted from declines in the positive fair value of interest rate and credit contracts. It's the same shit that's happening now. It's a large increase during the first quarter of 2020 as markets responded to the financial impact of COVID. NCCE ended the first quarter of 2021 lower at $446 billion as more normal market activity resumed. And they call it more normal just because the government was still pumping all sorts of cash. So here's the corporate and counterparty percentages. Okay. The bulk of the financial system is concentrated in banks and securities firms. The combined exposure to hedge funds and sovereign governments was supposedly small, and a more risk-sensitive measure of credit exposure considered the value of collateral held against counterparty exposures. I'll skip right over that, but that's consistently growing, and it's growing exponentially, as you can see. All right. Look at the composition of collateral. Looks like everything keeps getting riskier. It's probably all they got left. And then the value at risk in millions of dollars. That doesn't really mean anything right now. These numbers are all too skewed. I'll let you take a look at that for yourself. We can switch right over here. Take a look at the credit equivalent exposures from the top 25 commercial banks for yourself and see how much they are. The assets compared to the derivatives. Look at the over leveraging that's going on here. Again, expressed in billions, not in millions. Look at these derivatives. And again, remember everything that is not included on these. Okay. The top 25 commercial banks hold 188. The top 25 hold 187. And the top four have 90% of that, 89% to be exact. Top four commercial banks, SAs and TCs with derivatives, $168 trillion. I forgot. Yeah, this is in millions. So that's $168 trillion. Taking a look further. And these numbers just go on and on. Now, over the counter stands for dark pool. What are they doing? Morgan Stanley. Come on. Goldman Sachs. Look at this. Over the counter, everything for foreign exchange. None of the foreign exchange is cleared through the centrally cleared exchanges. Look at this. Equity. Precious metals. All dark pool. 18% through Citibank. Good for you. You tried. Investment grade. This is all price suppression. Non-investment grade. And OTC for others. It's just the hundreds and 99s down the board. And totals, 58, 53. Look at HSBC up at 92 and Morgan Stanley Bank, 100% of their total traded. They didn't have much. But you got to add them all up. So, yep, they had pretty sizable positions. All they're doing is using their dark pools. That's pretty pathetic. It's a damn shame. So, yeah, let's keep moving on because I'm having fun here now. We're getting into some craziness. I still look at this. Look at this. Like I just glanced over this myself. Look at the trading assets. 2008. And then what's happened? Well, %80 lower. 80% level 3 trading assets are 80% lower than the peak from 2008. Look at the VIX in 08, in 11, 16, 18, 20, and we're priming for the next one. They reduced their credit derivatives exposure. They just moved into shell companies. There's nothing's changing. Look at these credit derivatives contracts. Derivative composition. Okay. You see this is 2,898 billion. Okay. So that's in the trillions. This is just sad. All right, let's move on. Compression activity. Notional amounts of banks' derivative contracts have generally declined since 13 because of trade compression efforts, leading to less need for risk management products. Yeah. Yeah, they're definitely, they're going down. Sure, if you say so. Look at this. Centrally cleared derivative contracts as a percentage of total. That's the same thing we just saw. More than half is going on dark pools. This is just saying how much is not going on dark pools. Again, for those of you that were wondering what bilateral netting is, you guys can pause right here. This is a legally enforceable arrangement between a bank and a counterparty that creates a single legal obligation covering all individual contracts. The arrangement means that a receivable or payable in the event of default of one of the parties would be the net sum of all positive and negative fair values concluded. So remember all those what we saw together, those 20 contracts that equal $150. They're basically trying to get out of all those contracts by just paying that. The defaulter paying the other bank that $150. Crazy. What's a derivative? There you go. Read that if you want. Deposits, swaps, futures, structured debt obligations, options, caps, floors, collars, forwards, and various combinations, of which there are millions. There are millions of combinations. They've taken mortgage-backed securities and credit default swaps, just shuffled them around and given them fancy new names. They're taking ETFs, jumbling them together, and shorting the hell out of them to try to keep the market in the place that is most advantageous to them. And they can't do it anymore. They can't do it anymore. We'll get into that on other videos. If you haven't seen the past videos that I did with Jackson Hunter and Dave from Dave's Daily Trades, and you'll see what I'm talking about. I have no idea how long this video is going to be. So if you're bored, go ahead and skip forward or figure it out for yourself. But the reason that I go through these is to figure out what the future is looking like for my investments, my companies, and the real estate market, foreign equities, Forex, the derivative notional amounts by type. And in 2008, they were here. Currently, we are here. Yeah, that doesn't look good. Here's 2011, debt ceiling crisis. What happened? This. It's still just fighting, but Lower highs, lower lows. You can see the trend. You can see the trend from back here. It's going to continue, but we need it. We're going to have a sharp correction. It's going to turn into like a camel's hump. Now here's the derivatives by product. What do you have? Majority in swaps, options, and futures. There you go. This $169 trillion is the top four banks. JP Morgan Chase, Bank of America, Goldman Sachs, and who do we have? Citibank. Yeah, Citigroup, who happens to own or who happened to purchase Salomon Brothers. Salomon Brothers Bank owned the majority of Tower 7 in that was destroyed on September 11th. And many, many files were lost in that building. Files that were essential and most likely included things that a lot of people that Salomon Brothers didn't want a lot of people to see. So I'm not saying it's a coincidence. I'm just saying it's convenience. I don't know anything more than that. Here you go. Credit exposure. What's been happening here? Not much. They're reducing it ever so slightly. They're trying to taper it off. They've just been shelling it out into shell companies, literally. We saw that from the holding companies, how much it's increased. Holding company trading revenue. Okay. It's up 200%. What does that mean? They have moved tens of trillions of dollars, maybe more, tens of trillions of dollars to these locations. Look at this. Consolidated holding company trading revenue of $27 billion in the first quarter was $8.8 billion higher than the previous quarter. The increase was primarily due to increases in foreign exchange, equity, commodity, and credit trading instruments. Increases in these instruments that we know what they are. What's the only thing that's down? Interest rate. Our bonds, our 3-month and our 5-year and 10-year and everything in between. They are not looking good. I'll pull that up for us next. We'll get into interactive broker here later on. As you can see, the S&P 500 fell 1.1% on Wednesday, as well as the NASDAQ, Dow Jones, and the Russell, because, well, the Russell got shorted to shit. I'm sure of that. But let's slide over here to this RRP info. Look at this. Look at this. Let's go back to 2008. Look at how little that was. Look at what's happened since then. When did this occur? 2013. 2013 debt ceiling. Government discussion. Debt ceiling crisis was shot up, and it's been on the rise ever since. Okay, so that was 2013 debt ceiling back there. September 23rd, September 27th. think that's important, actually. Let's take a good look at that. September 25th, 6.24. September 30th, 58. December 14, and then 197. Now look at where we are because of inflation. And the banks just having ridiculous amounts of money. We are at an all-time high, almost $1.2 trillion in daily repo and reverse repurchase agreement treasury securities being sold by the Federal Reserve. Why? Because the banks need this money available in their bank accounts in order to prop up the stock market and to make sure that they maintain enough liquidity to manipulate the stocks that they need to manipulate to prevent from going bankrupt. Because the moment that one of these stocks goes out of hand, gets higher, too high for them to handle, the cascading effect that's created will severely damage their entire company. These top four banks and all of the market makers and hedge funds underneath them are in extremely bad shape. Not all of the hedge funds and market makers, but the ones that are shorting stocks like Tesla, AMC, and GameStop, they're going to get wrecked. They're in beyond repair at this point. They cannot be saved unless all 5 million retailers in AMC and GameStop sell their positions. And I have no idea what anybody else is doing, but I know I'm not selling it until I see ridiculous gains, ridiculous share prices. That's what I know for sure. We'll get into it further in the future.